Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 247 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Well, today I'm going to focus on one particular way to invest your money. Now, it's rare that I do this. It's rare that I spend time just talking about one way that you can invest your money, but this is a particular way that intrigues me. And I'm not suggesting that you invest this way, and I'm not saying that this meets your risk tolerance, and I'm not saying that this meets your return expectations, but I do find it very intriguing because in finance, we have this thought process of maximizing reward for the least amount of risk. And this particular way of investing that I'm going to talk about today tries to do that, and I think it does it pretty well. So we're going to talk about all this and more in today's episode, so stick around to get more of the details. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things that I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can be working together, building financial goals that are specific to your life, and then pushing towards long-term financial freedom and ultimately getting you to a place financially where you can be financially independent and do all the things that you wanted to do, hopefully with the money that you have, with the money that you built, the wealth that you built, by using the principles that we talk about on this show on a day-to-day basis. Now, what particular way of investing am I talking about today? What particular portfolio am I talking about today where I think it is quite intriguing? Well, I wanted to talk about Ray Dalio's all-weather portfolio. And you may have heard of this, you may not have, but this is a particular type of portfolio that looks to weather all storms in financial markets, and it looks to minimize risk and maximize return, just like everybody else is trying to do. They're trying to get the most return for the least amount of risk. Well, it does so in a very strange way, and it does so via asset allocation that is different from what most traditional money managers may suggest. Now, you may be thinking, well, who made this up? Whose thought process is this? Why is this intriguing? Why might this be a possible investment choice for myself? Well, this was developed by Ray Dalio, and Ray Dalio is the founder of the world's largest hedge fund, Bridgewater Associates, and it manages today roughly $150 billion. Okay, now Bridgewater is so large that they don't take on new clients. Now, this is pretty common of a hedge fund. They won't take on new clients after some time just because you get too much money, many inflows. It's hard to make returns with that money. And even with 150 billion, it's probably quite difficult to make outsized returns, but he goes about doing it. And Ray Dalio, he kind of stepped back in Bridgewater Associates in recent years and has kind of taken a more advisory role in the company, but he has for years and years been innovative in investing. He has for years and years been innovative in the hedge fund space and in the space of risk and return. And so I think he's really, really interesting. And some even call him the Steve Jobs of investing. And he's got a few books, one of which I've read and a couple of which are on my list. But I've read the book Principles, and I think that's very interesting. He also has some books on debt crises and just success in general, because obviously he is a very successful man, came from very little. So Ray Dalio is the individual who built this portfolio, who built out this particular portfolio that I'm going to talk about today. And this portfolio is very, very simple. It is not a difficult portfolio to track with or follow. Okay, this all-weather portfolio is not anything that you can't create on your own. This isn't something where you have to go to some hedge fund or you have to go buy a specific ETF or mutual fund to track this particular portfolio. You can take a few different investments and put them together in certain allocations and get this all-weather portfolio that Ray Dalio suggests. Okay, now maybe not in the perfect way that Ray Dalio does so, right? But in the way that he suggests that investors do so if they're not invested with a hedge fund like his own. Okay, so what is this all-weather portfolio and what does it look like? Well, obviously, when we're saying all-weather, we're suggesting that this is a type of investment that will span all different types of markets, right? It doesn't matter if the market is great or the market is crappy. This could be a particularly good investment, especially when it comes to risk and return. Okay, so how does Ray Dalio set up this particular portfolio? Well, it is quite simple, okay? He starts with fixed income, okay, or bonds. Now, fixed income is just a fancy way of saying bonds in most cases, but fixed income means that these particular types of investments would pay you some fixed amount of interest or some fixed payment over time. So fixed income is generally bonds or preferred stocks, okay? But we start with fixed income, and he puts 40% of long-term U.S. bonds, U.S. Treasury bonds in this portfolio. So 40% of long-term Treasury bonds. That's a very, very large allocation of bonds, right? And some may say right off the bat, well, how am I going to make any returns if I start off with 40% Treasury bonds, with 40% long-term bonds? How am I ever going to make return? Well, just hold on. And this is going to be the beauty of this particular portfolio, because it is not constructed in a way that you or I would traditionally think you could construct a portfolio and create a risk-return relationship that would work out for a particular investor, okay? So you start with 40% long-term U.S. bonds, and if you wanted to take this type of allocation on your own, that particular bond weighting, you could use the TLT ETF, okay, so that tracks long-term treasuries, okay? So 40% long-term treasury bonds, then 15%, still in the fixed income space, of intermediate term U.S. treasuries, okay? So this is going to be the IEI ETF, all right? So if you're looking for this, again, if you want to take this allocation for yourself, the IEI would be the ETF you use there. So we're at 55% bonds, and we haven't even talked about stocks yet, right? There has been no stock allocation, and we're already at 55% bonds. How are we ever going to make our returns? How are we ever going to have some returns that are adequate for most investors? Well, again, just hold your horses. Now, your question may be about the stock allocation. Let's talk about it, okay? The stock allocation is 30% of the portfolio, only 30%. Okay, only 30% of this portfolio is going to be stocks, okay? And it is suggested that it's U.S. large cap stocks, and he suggests using the VTI, so this is the Vanguard Total Market Index, okay? And this is going to be 30% of that particular portfolio. All right, so we've got 55 and 30%, so we've got 15% of this portfolio left. And this is where it gets a little more interesting. It's not just stocks and bonds, okay, because we know that many traditional portfolios are just stocks and bonds. But this, gets not tricky, but a little different in this last 15%. So 7.5% is going to go into gold, okay? So that is, a commodity play, right? It is obviously a hedge against some of the other investments, the traditional investments that you may hold here, right? So 7.5% goes into gold, and he's not talking about buying these, gold bars or whatever. He's saying the GLD, right? There is an ETF for that, just like there's an ETF for just about everything, okay? So 7.5% goes into the GLD gold ETF. And then another 7.5% goes into a broadly diversified commodity ETF, the GSG, okay, which tracks different commodities in the market, okay? So you've got 15% commodities, 30% stocks, and 55% bonds. How in the world does this create the returns that you're looking for? Well, just based on the hedges of risk and the correlations of the returns of these different ETFs, it turns out to be quite effective at creating good returns over time. Okay, so let me just give you the everything from the 1 month return all the way to the 10-year return of the Ray Dalio all-weather portfolio. So as of June 30th, right? So the end of June of this year, the 1 month return in June was 2.21% for the all-weather portfolio, so it had a good month. The 3-month return, 6.9%. Okay, and again, these are on an annualized basis. All right, 6-month return, 2.93%. The 1 year, okay, so going from June 30 to June 30, 2020, right, going back to June 30, 2020, 9.97%. Okay, so that is a pretty good year, but not what the S&P 500 turned out over that time period. Okay, over a 3-year period, 10.53% annualized. Okay, over a 5-year period, 7.54% annualized, and then over a 10-year period, again, we like as we can look at longer periods for a particular investment and see what it has done. Over a 10-year period, this particular portfolio has yielded 7.72% annually. Okay, so no slouch as far as returns. Now, do I hope that we could have gotten more than 7.72% annually over the last 10 years, especially as younger investors? Sure, but 7.72% is no slouch. If you go ahead and just take inflation into account, you are still growing your money at a good, real clip, especially if you're somebody who doesn't want to take a ton of risk. This type of portfolio can do that for you. And you may be saying, well, how does this portfolio not take risk? You're investing 15% in commodities, and you do still have stock exposure, right? And you're investing in longer-term treasury bonds, right? Now, longer-term treasury bonds obviously are never considered risky, but longer-term bonds are riskier than shorter-term bonds. So how would you, quantify this as lower risk? Well, let's just talk for a moment about the drawdowns of this particular portfolio. And that's a really big thing when you're looking at ETFs or mutual funds or the performance of some hedge fund manager or whatever. You look at max drawdowns, meaning the maximum that the portfolio went from peak to trough. Okay, so from its highest point to its lowest point, what was the largest fall that the portfolio had? Okay, so in the 1 month period, again, this is ending June 30, 2021, right? 1 month period, there was no max drawdown. 3 month, no max drawdown. Over a 6 month period, okay, going back to January of 2021, the max drawdown was 3.71%. Okay, now I don't know what that was for the market over that period of time, but it was 3.71%. So also year to date, 3.71% is the max drawdown. All right, then over a 1 year period, okay, the max drawdown, 3.74%. All right, 3-year period, max drawdown, 4.76%. Okay, 5-year period, max drawdown of 6.47%. And over this 5-year period, we have to remember that we have had some really, really major drawdowns. We've had some really, really major falls in the market. Okay, so this decline of 6.47% is chump change compared to the coronavirus crash or compared to some of the corrections that we've had. Nonetheless, a 10-year max drawdown was 6.93%. And then if you take the max drawdown since July 1st of 2002, the max drawdown for this portfolio would have been 12.19%, and that was amidst the financial crisis when the stock market itself fell by over 50%. So now you can kind of start to see that with those 7.72% annualized returns, how it's going to be difficult to find anything else similar to this that's going to have such good returns, right? So I said good, not great returns. So good returns that still provide you with a low amount of risk. So if your largest drawdown in your portfolio is 12.19%, dating back prior to the financial crisis, you've done something right investing wise, and maybe it is eliminating risk. And I think that's something that has been done really, really well by the all-weather portfolio. Okay, so again, 7.72% annualized return over the past 10 years. So an investment of $1,000 10 years ago in the all-weather portfolio, a $1,000 investment would have become $2,103.46 as of June 30th of 2021. Okay. Now, if you back that up even further, right, and you go back to July 1st of 2002, a $1,000 investment would now be worth $4,337.07. Now, just for a little bit of perspective, because I don't want to be such a fanboy of the all-weather portfolio that we lose our way, right? Let's just take a look at the S&P 500. So if I go back and look at the S&P 500 from June 21st of 2002, the S&P 500 was at 989.14. Okay, and as of close on Monday, the S&P 500 was at 4,384 and 63 cents. Okay, so that would be a gain from June 21st, which is just a little before the July 1st date that we were looking at, of 343.28% over that time period. Okay, so 343.28. Well, what about the all-weather portfolio? Well, over that same period of time, the all-weather portfolio has provided 333.71% return, okay? 8.03% on an annualized basis. So this means that even with an allocation that was 55% fixed income and 15% commodities and only 30% stocks, right? The all-weather portfolio has only trailed the S&P 500 portfolio, which is obviously all stocks, right? All large cap U.S. equities. It has only trailed that portfolio by 10% over a 19-year period, right? That is outrageously good. And with the largest drawdown over that time being only a little over 12%, that is an absolutely huge deal for investors and could really allow investors to grow their money. And I wish I could show you this chart of the all-weather portfolio. It is truly, and you could go create this portfolio for yourself online and follow the growth over time. But it's almost just up and to the right. Now, it's not the steepest up and to the right that you've ever seen, but it is just up and to the right, which is absolutely fantastic. Now, let's talk for a minute about the worst drawdowns that have been had in the all-weather portfolio. Again, I told you about the largest drawdowns, okay, but let's talk about the longest drawdowns, okay? So I've told you about the largest. Let's talk about the longest. The longest drawdown that this portfolio has had since June of 2011 was between February 2015 and December of 2015, and that drawdown was 6.93%. Right? And it ended up taking 17 months total from one top to the next. Okay, so it took 6 months to recover from that particular drawdown. It took from February of 2015 to June of 2016 to just break even in the portfolio. Okay, but that was the longest drawdown. And just for a little bit of perspective, again, we're trying to compare to something like the S&P 500, not because it's an apples to apples comparison or that's the benchmark that you would use, but because that's what a lot of individuals are investing their money in a passive way. And we are trying to make an argument for maybe there's another way to passively invest your money. Okay, so let's just take a look at the peak of the financial crisis. Okay, so the peak of the financial crisis, we're talking September of 2007, before everything fell off of a ledge. Okay, September of 2007 to January 18th of 2013, right? So that's like, 5.5 years that the market took from basically one high to the next. The market was basically flat over a 5.5 year period. And even worse, if you look at something like the NASDAQ over a longer period of time, but again, that is more risk. Therefore, it's going to take longer to get over some of those drawdowns. So as far as drawdowns go, the all-weather portfolio does absolutely great. Then let's talk about some rolling returns. And if you don't know what a rolling return is, rolling returns are where you look at, let's say, you have 1 year, right? And if you looked at 1 year rolling returns, you'd look at 1 year, then the next year, then the next year. If you said 5-year rolling returns, you would say, okay, from 2016 to 2020, that's a 5-year set of returns. But then if you're looking at rolling, then 2015 to 2019, that's 5 years. And then 2014 to 2018, that's 5 years. That's what we mean by rolling returns, where they overlap in that way. Okay, so if you look at 5-year rolling returns of the all-weather portfolio, okay, the best 5-year period was 11.47% annualized, and the worst 5-year period was 4.08% annualized, with the average 5-year period being 7.27%, so right around the average return of the portfolio. Now, if you look at the 3-year, okay, the worst 3-year rolling return was 1.77%, and the best was 15.92%, with the average being 7.45%, okay? This means that any time from July of 2002 to June of this year, Okay, if you invested in this portfolio for 3 years, you were going to make money. Now, if you go down to 2 years, there was a negative 2-year rolling return of negative 0.97%. So you barely lost money. Okay. But if you would have invested your money for any 3-year period over the last 19 years, you would have made money in this portfolio. Now, what was the best year for this all-weather portfolio? What was the best year that this portfolio has had? Well, the best year was from April of 2003 to March of 2004, and that was a 20.18% return. Now, you may say, well, how have they not made returns in the most recent bull market that are as large, right? Because we've had some pretty blowout years, especially in the S&P 500. We have to remember they are hedging risk. Right? They have commodity plays. They have a lot of bonds. So the returns may not have been as robust, okay? But in not taking losses over the long term, what the portfolio ends up doing is just racking up gains steadily, just slowly but surely picking up gains and allowing them to not have to make 20% returns or 25% returns annually in order to get to some semblance of good returns over time. Okay, so that is the best returns that we've seen from the all-weather portfolio. Now, you may also ask, then what's the dividend yield on the all-weather portfolio look like, right? What do we have as far as income off of the things that we're investing in? Now, obviously, gold and commodities are not going to provide you with any income. Your fixed income investments in the portfolio, the IEI and the TLT ETFs, may provide you some income year after year, and then so will the total stock market index, obviously in the form of dividends, okay? But what can you expect? Well, right now, if you invest in the all-weather portfolio, it would have a 1.4% yield, meaning you would make 1.4% in just income, right? But over time, what have these yields looked like? And we'll look back to 2007 and then all the way to today. Now, in 2007, the yield was 3.15%. Now, obviously, the lower the values are on a particular portfolio, typically the higher the yields are going to be. So in 2007, we're coming out of a financial crisis. Yields are going to be relatively high as long as companies are continuing to pay dividends, okay? So 3.15% in 2007. And then I'm just going to go right down the line, 8, 9, 10, all the way to June of 2021. But you have 2.82%, 2.44, 2.73, 2.58, 1.95, 1.91, 2.12, and then in the upper ones until 2019, then it was 2.03, then in 2020, 1.4%. Okay, if you would have invested in June 2021, right, the yield is only 0.49% on the portfolio, okay? And that's obviously because a lot of companies have cut dividends since last year, and when you have higher valuations, yields are going to be lower, okay? So it's also important to note where some other return comes from, and some other return may come from the dividend yield portion of the portfolio. But this is not what makes this portfolio shine. What makes this portfolio shine is the lack of drawdown, and yet the good returns that it can provide. I think that this portfolio does better for individuals who are going into retirement or are closer to retirement, and they are wanting to take some risk off, yet they still need to make adequate returns, because we've talked before about, when you're going into retirement and you're heading towards retirement, you don't need to just take all risk off, because you need to be growing your money because of, one, inflation, and then two, if you're withdrawing money in retirement from your accounts, you need to have adequate returns in that way as well. And you don't want huge drawdowns, because having huge drawdowns would mean that the particular portfolio might provide you with the double whammy of the drawdown and you're taking money out. And so when it tries to grow back to the amount that it had previously in the portfolio, it's going to take longer to get there. Okay, so we don't want to have those double whammies. So not having large drawdowns is a very big deal in a particular portfolio. And the all-weather portfolio provides lower drawdowns, or has historically, okay? So this is something that I do think is interesting for retirees. And you look at the average return, right? The average return is about the 7.7% annualized, right? Or if you go back to 2002, it's right around 8%. Okay, so if you look at this annualized return and you think, okay, let's assume that we're taking 5% annually off of our nest egg, off of our retirement portfolio. Okay, and let's just make the assumption, and this has not historically been the case, but let's say that this is the case, that inflation was running at 3%. Okay, so even if inflation was running at 3% and you were taking 5% off your portfolio annually since 2002, over a 19-year period, then what you would have ended up with is a portfolio that in real terms would have had a 0% growth. Now that sounds cruddy, right? That doesn't sound like a good thing, but that means it had a nominal growth of approximately 8% annually. Inflation ate away at 3% of your return, and 5% of your return was going just towards providing you with your income. So you were getting the income you needed and still maintaining the value of your portfolio on a real basis, meaning that the purchasing power of the portfolio remained the same, right? You could still buy all the same goods and services with that same amount of money, even though you did see the value grow. So your money grew, and you had a situation where you could take all the income that you needed off of that portfolio. So just historically, this would have been a very good way to invest your money, especially in a place where you needed to de-risk and still make good returns. Now, why do I talk about this? Why do I tell you guys this? Why am I interested in this particular situation? Well, I'm interested in the all-weather portfolio because I think for all investors, what you're trying to do is find the thing that works best. Find the thing that provides the most return for the least risk, right? Risk and return, it's a big topic in investments. It's a big topic in portfolio management. And so when you see something that has historically worked and that has provided returns with minimum drawdowns over time, I think it's worth noting, and I think it's worth talking about. And again, I'm not suggesting this for you. I'm not suggesting this as something that you should just go invest in today. But what I am saying is that something like this can be a useful tool. It can be a useful portfolio for individuals who are in the business of trying to take risk off but don't want to sacrifice all of their returns. Okay, so Ray Dalio, very brilliant man, done a lot of brilliant things in the investment space, and he has provided a lot of wisdom, especially in the recent years, to investors throughout the market. But this contribution of the all-weather portfolio, I think, is a very, very large contribution into the investment space. And I'm not saying he's the only one who has a portfolio like this. There are other portfolios who have done similar things, but Dalio is a very famous individual, and this portfolio did become very famous, especially through Tony Robbins, who went and wrote the book about individual investing, personal finance, and things like that, and took a lot from Ray Dalio, who talked about the all-weather portfolio to Tony Robbins when he interviewed him for that book. So you can thank Tony Robbins for your all-weather portfolio knowledge. So hopefully this helps some of you guys. Hopefully this gets you to a place where you can understand risk and return a little better and understand that the traditional ways, the historical ways of investing, even though tried and true in many ways, can still be adjusted. You can still have very low stock allocations and still make good returns. You can still have allocation into commodities and stocks and still have very low drawdowns. It's all about correlation of returns, and it's all about determining risk and when risk will present itself, and then what returns you can expect on the other side. So the all-weather portfolio, you might try it out, you might not, but I do think it's quite intriguing, and hopefully this is something that you can look into more for yourself as you go forward. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things that I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody who would help you build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites. Tell me that you're interested in financial coaching, and you and I can begin working together building financial plans that are specific to you and your family's needs, and then pushing you on towards long-term financial freedom by attaining those goals that we've set out for you to attain. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.